Hello friends, in today's video we are going to talk about yield curve inversion. Now 2019 has been an awesome year for US stocks with S&P 500 showing an approximate 20% return year to date till mid-September. All in all, a great year to be in the US financial markets, whether you are invested through your 401k retirement account or your individual brokerage accounts. However, if you like to follow the financial news, then recently you must have heard a lot of noise around yield curve inversion and how it affects the financial markets. Now, we all work very hard for our money, and bad news really scare us. Why? Because it's all about the money. Now, money can ensure financial security, money can ensure a good retirement, money can buy you a nice BMW, and money can ensure that your kid gets to go to a good college. And the thought of losing money is just terrible. So, in this video, let's learn more about yield curve inversion, why the yield curve inverts, and what it can potentially mean for your financial investments. Before we get into the yield curve, let's have a small primer on interest rates. Assume a conversation between you and your friend where you request a loan of $10,000 from your friend. Now, he's a great friend and he's willing to loan you the money, but he will expect a small return for his kindness. That return is what we call interest. Let's assume he asks for 5% interest for a 1 year loan. You agree, but out of curiosity, you ask for interest rates for a bigger loan term of 5 years. So this time, your friend says he's going to charge you a 10% interest rate. Now you're flabbergasted. Now, why would your friend charge a higher interest rate for a longer term period? This is because interest rates are generally higher for a longer term because the interest rates for a loan are primarily affected by two variables: inflation rates and probability of default. As the duration of loan goes up, inflation is going to eat into your friend's return, and he in turn is going to ask for higher rates for longer term loans. Also, your friend loves you till death, but he knows that the longer he loans you the money, the higher the chance you're not going to pay back his money. Therefore, he's going to demand a higher interest rate to be compensated for his risk. So, what we have learned so far is that higher the long term period, the higher should be the corresponding interest charged on that loan. In other words, the interest rate term structure should be upward sloping over time. So, what is the Treasury yield curve? Now, imagine that instead of you, this time it is the US government asking for a loan. Now, why would the US government do so? Let's say the US government is trying to source capital for infrastructure development and needs the money. The US government then issues debt through the US Treasury by using debt instruments called Treasury bills, notes, or bonds. Treasury bills are short term instruments that mature within 1 year. Treasury notes mature up to 10 years, and Treasury bonds have longer maturities up to 30 years. Now, earlier in the video, we discussed that interest rates are affected by inflation and probability of default. With the US government, the probability of default is very, very low, but there is still inflation risk that can eat into the returns over long term. So, Treasury yields are the total amount of money you earn by owning US Treasury bills, notes, or bonds. It is very important to understand that yields move in opposite direction to bond prices. If there's a lot of demand for the bonds, then bond prices will increase in the secondary markets, and that lowers the yield that you earn on the bond. We will keep talking about this primary principle throughout the presentation. So the US Treasury yield curve is nothing more than the plot of yields on all Treasury maturities ranging from 1 month bills to 30-year bonds. Now, the normal yield curve should be upward sloping because you would normally expect higher yields for longer term securities. Another term that keeps popping up is the word yield spread. Now, the yield spread is simply the difference between two reference rates. For example, the 10-year, 2-year spread is the difference in yields between the 10-year Treasury note and the 2-year Treasury note. Similarly, the 10-year, 3-month spread is the difference between the 10-year Treasury note and the 3-month Treasury bill. Now, generally, the spread should be positive because you would expect higher yields for longer term securities. However, the spreads can turn negative, and that's essentially when the financial markets get concerned. So, how does the Treasury yield curve look now? Now, we have said again and again in the video that the yield curve should normally be upward sloping. Now, the chart below shows the US Treasury yield curves plotted at different points of time. Now, if you look at the curve at the top, this is as of October 2018, and it is normally upward sloping. However, around the middle of March of 2019, the yields on the 3-month Treasury bills became more than the yields on the 10-year Treasury notes. Then in August, the yields on the 2-year Treasury notes became more than the yields on the 10-year Treasury notes. And that is exactly what we call yield curve inversion. And that is also when all hell broke loose into the financial markets. So why does the Treasury yield curve invert? And why is that a cause of concern? The Treasury curve inverts because the yields on the longer term government bonds are lower than the yields on shorter term instruments. So why should that even happen? This happens because the investors expect a slowdown in economic growth and a reduction in rates, and investors rush into long term government bonds to lock in the rates. When demand for the longer term bond goes up, then the price of the bonds goes up as well, and that's when the yields on those bonds drop. What is worrisome is that an inverted yield curve has preceded every US recession since World War II. Now, recessions can be bad with the fall in financial markets, increased unemployment, and gloom all around. However, that does not mean that all the US yield curve inversions have preceded a recession. So, that's essentially saying that US yield curve inversion can also be a false alarm. So, what should an investor do? If you have noticed recently, a weird phenomenon has taken over the investing world. It's called negative yields. So, right now, there are trillions of dollars of sovereign debt around the world that have a negative yield. A case in point is Germany, where the German 10-year bonds pay a negative yield. That means an investor can expect to receive less than what the investor has loaned. And this is mind boggling. Seen in the context of negative yields, so the current rate or returns on a 10-year US Treasury bond is like a heaven sent return. Also, past data suggests that there is generally a lag between the time the yield curve inverts for the first time and the actual recession. The financial markets can even go up between the time the yield curve inverts and an actual recession. So, what should an investor do in times like this? Now, each case is different, and right now is the correct time to monitor your personal investments for suitability and to look at your personal risk appetite. Now, sleeping easy at night is important, but also remember that no one makes money by sitting at the sidelines of the markets. Thank you so much for your time for going through this information today, and hopefully you found this information useful. Thank you.